We've got a lot of questions lately over the weekend, especially about what happens when a bank fails. In this case, it's Silicon Valley Bank that we're talking about. It's seemingly an abrupt, quick bankruptcy from the bank, I think is what we're looking at, or at least a run on the bank is what happened late last week. So first of all, we're going to cover today, how does this happen? Why did it happen to Silicon Valley Bank? What does it mean to us as investors, maybe the stock market, how might it react? And what does it mean for other banks? Banks that we may have our monies at, our cash and our checking or saving, or even our Schwab accounts or other broker dealers similar to Schwab, Fidelity, Vanguard, etc. So let's jump right in. First of all, why did Silicon Valley Bank go under? There's many different reasons. It sounds like they made a few strategic errors combined with some economic things going on, such as rising interest rates, really hurt and damage their ability to stay in business. For example, Silicon Valley Bank was mainly a bank to venture capitalist firms. Obviously, it got its name from being in Silicon Valley, and it specializes in serving businesses that are in the high-tech industry. The high-tech industry has taken a brutal beating in the last year or so, and just the value that those companies have lost in the stock market. The values of those companies have gone down. So that negatively affected Silicon Valley Bank, along with the types of investments they were holding. For example, some of the investments they were holding as a bank or long-term bonds. So what happens when you own long-term bonds and interest rates go up, the value of those bonds goes down significantly. So that's one of the things that Silicon Valley Bank was invested in. And each bank takes depositors' deposits, and they invest that money somehow. And then that's how the bank makes money. So also, they didn't have enough cash on hand when investors or their customers wanted their cash back. So they invested too much of their cash and didn't have enough in reserve. So what happened is the word got out early to mid last week. Moody's credit rating agency was getting ready to downgrade their credit. And then they made a report that their balance sheet was in trouble. So people wanted to withdraw their money. The reason why they went out of business so quickly is because that so many of their depositors were very large depositors. So it didn't take a lot to remove a very large amount of money. And at that point, the bank, basically there was a run on the bank and the government had to step in. Luckily, at this point, the government has stepped in, FDIC has stepped in and guaranteed those depositors their money. That's a good thing. Otherwise, it could have had a ripple effect such that if I'm a company and I'm banking with SVB, then I need money to pay payroll, to pay my business expenses, and I can't get to it. That could negatively affect me as a company, therefore causing a ripple effect. So it seems like at this point, with government intervention, that's not going to happen. So that's a good thing for the economy and affecting other businesses. Now, what does this mean for the stock market? Like I said, the economy in general. Well, it could scare some people. Oftentimes in the news, you'll hear the word sentiment, negative sentiment. And so some bank stocks today are probably down. People are a little bit afraid of bank stocks in general. And so typically when that happens, you might see a short-term decline. We don't know how long that's going to last. We don't know if that's going to spread into other parts of the market, but we think that is a possibility. In fact, as I talked today, I think the last I looked, the stock market was just about even. In fact, a little bit in the green. So sometimes these short-term events are very hard to explain and hard to know how the market's going to react. So what about your money at Schwab and your local bank? Most of you know that FDIC insurance covers up to $250,000 of cash at your local bank. Schwab has FDIC insurance on some of the cash that's there. If it's not invested for a while and that cash is sitting there, Schwab has a policy like many other broker dealers, like Fidelity probably has a similar policy where that cash can be swept into their bank. That's transparent to you and I as investors, and that becomes FDIC insured monies. In addition to FDIC insurance, Charles Schwab, as other custodians and broker dealers, have what's called SIPC insurance. That stands for Securities Investor Protection Corporation. That is a nonprofit agency where if something bad were to happen, they would step in and provide even more coverage. Typically, this is $500,000 more on investments and or cash as well. So what really would happen if, let's say, Charles Schwab went out of business. Now, let me first be clear that I think this is very, very unlikely. SVB had a very different type of business. Again, their business was highly concentrated into one customer base, if you will. They were not diversified in their line of business or loan book, as it's called. But what would happen in the real world, let's just say if Schwab or Fidelity went out? Well, basically, these insurances would step in and cover some of the investments. There also would be a pretty clean transfer of your investment holdings. You own those investments. You and I own our investments. They just happen to be held at Schwab. They could simply be moved to another broker dealer such as Fidelity. So again, these are pretty rare as far as history is concerned, but Congress stepped in back in the 1960s to make sure that there was a protections for consumers if they're a broker dealer or custodian. Those are kind of used interchangeably. If they went out of business, your investments could simply be transferred to another custodian. So Charles Schwab actually put out some information today that I thought was useful and helpful. And they wanted to explain and put everyone at ease about their business model and how they operate. And so basically their CEO and co-founder, actually Charles Schwab himself, put out some information today. And it says, Schwab has a broad base of high quality customers across multiple lines of business. So basically what they're alluding to is that the Silicon Valley Bank did not have those. They were overly concentrated. Capital well in excess of regulatory requirements, a high quality and relatively small loan book, and a conservative investment portfolio that is 80% comprised of securities backed by the U.S. Treasury and various government agencies. So they go on to say, following the recent events in the banking industry, we are pleased to see the U.S. Treasury Department, Federal Reserve, and FDIC step in with decisive action to support depositors during this critical time. We think the steps announced today provide an additional layer of protection for individuals and will help boost confidence in the American banking system. So lastly, I think it's important to know that they talk about investments at Schwab are held in investors' names at the broker-dealer. Those are separate and not commingled with assets at Schwab's bank. So those things are helpful to know. And in these large broker dealers like Charles Schwab, Fidelity, others out there, one other is called Pershing, they're very solid financially. There's a lot of government regulations that help to ensure that they are a little bit safer for the consumer. So I hope that helps a little bit. Basically, the last thing I'll say is that through diversification, we own hundreds, even thousands of companies all over the world. If one bank goes bankrupt, then we don't anticipate that hurting our portfolios. Obviously, there is the psychological effect, people getting fearful, selling their stocks, which causes the prices of some stocks to go down and maybe the overall market. That is very possible and happens quite often. But otherwise, this is why we're diversified, owning many different types of companies all over the world. So that helps us to maintain our game plan and know that your retirement, your investments can still be successful even if a bank goes bankrupt and there's a run on a bank. So hopefully that is helpful to you. Please reach out and call us if you have any questions. We'd love to hear from you. Thank you so far for all the questions and comments that we've had about this topic. It's very interesting.